Welcome to Distribution Talk with Jason Bader, the show where we dive into the stories, struggles, and solutions from business owners and thought leaders in the wholesale distribution market. Hey friends, Jason here. In this episode, I had the opportunity to speak with Mark Ritter, CEO of New Direction Lending. His organization specializes in bringing traditional business financing to the credit union market. Everyone has a warm, fuzzy feeling about credit unions, and you might have your personal accounts with one of these entities. But most of us don't really look to them for our commercial needs. We tend to look at these large, heartless entities for our lines of credit or commercial real estate loans, and often have a love-hate relationship with those organizations. Perhaps we just don't know what a credit union can do. Mark does a great job in explaining what makes the credit union really special and how it can be a solid option for the small business community. I enjoyed the conversation, and I hope you do too. This episode of Distribution Talk is sponsored by InSQL Distribution Software. InSQL is a fully functional distribution-based software package. I say distribution-based because that's important. Many alternatives out there say they do distribution, but they really aren't very good at it. They're generally watered-down manufacturing packages with a few distribution features tacked on. I only recommend software packages that were purpose-built to serve distribution, and these folks do it very well at a price point many smaller distributors can afford. If you're ready to step up to a fully loaded, scalable distribution package at an affordable price, look no further than InSQL Distribution Software at www.insql.com. That's INXSQL.com. All right. Hey, Mark, welcome to Distribution Talk. Thanks for taking the time to be with me.
Jason, looking forward to it. Thanks for having me.
Fantastic. Yeah, I appreciate this. It's actually a really interesting topic, one that I hadn't thought about, but a lot of my clients have talked about finance, and small business people just have a little challenge around that. That's a tough topic for them.
People want to spend their time running their business and making money and not searching for it.
Yeah.
The process can be brutal.
Yes.
To find the right partners and navigating the waters.
So if you wouldn't mind, kind of give me a little backstory, if you could. How'd you get into this, coming out of school, out of mighty Penn State? How did you get involved with this whole world of finance?
Sure. I grew up in Northeast Pennsylvania among the steel mills and coal mines.
Sure. Yeah.
So I was about as small town industrial as you get. I always say it looks like the movie All the Right Moves.
Yeah. Oh, I remember that. Yeah. Sadly, I'm old enough to remember that movie well.
So I was a business major doing the first few years. I actually lived in Tennessee a few years, and I was doing the typical banking thing. Mm-hmm. And was really looking for a change of pace, somewhere where I could plant my flag, and loved community banking. And it was always community banking. Mm-hmm. I never wanted to be a Wall Street guy dealing with the mega corporations.
Sure.
I liked the towns. And the more I started digging, when I was trying to make this switch in my late 20s, there was a law that was just passed at the time that expanded and allowed credit unions to start getting into small business lending and real estate financing.
Gotcha.
Before that, it was virtually non-existent. Credit unions were everywhere. People loved their credit union. They just went somewhere else for their business.
Gotcha.
So 20 years ago, I started up a credit union I didn't start the credit union. It was existing, but they said, we want to do business loans. So they threw me at a desk. And at the time I was there, the entire credit union industry in Pennsülvania, where I was at, consisted of $13 million of loans.
Gotcha.
Well, now it's billions.
Right.
In a portfolio.
Sure.
But it was virtually non-existent. So we've really built it up, and it's become a growing industry. And our biggest competition is just word of mouth.
Yeah.
People love their credit union, but they just don't consider them for their small business and commercial needs. So yeah, I was there for 10 years, then started up with the company here outside of Philadelphia, where what the credit unions have done, instead of everybody building their own infrastructure and hiring all their own salespeople and their credit people and buying all the software you need to do to actually do commercial financing. They formed companies like us so they could offer all of these loans and financing to people a little bit better, faster, cheaper than everybody trying to do it themselves. So that's what the company that I'm the CEO of today is, MBFS. We are a credit union service organization that works with over 80 credit unions, bringing people all their small business and commercial financing.
Gotcha. So prior to this, to you getting involved on that commercial or just bringing these business loans in, people really use this as their personal, maybe checking and savings account. That was about it.
You're exactly right. My father worked in the factory, and he had always talked about his credit union when I was little and had no idea what he was talking about. But it was the corner of the factory. If he needed a car loan, he could get a car loan. If he had his checking account and a small savings account there, that's what he had.
Yep.
But really, over the years, especially the last decade, every credit union has really opened up their membership and eligibility requirements.
Yeah.
That was the other part of that law that was passed that allowed credit unions to do business lending, is to open up the membership criteria. So most people, I always say, if you're driving past a credit union in your hometown, there's probably about a 95% chance you could go in and open up an account. They tend to be more open to their local communities and to broader groups of people.
Yeah. I mean, if I really think about this, really it was niche specific. I mean, a lot of these, like, for example, like a teacher's credit union or federal employees, or as you said, like a steel mill. Yeah.
Yep.
Interesting. And, it's kind of funny you mentioned car loans. I have probably got 6 savings accounts in different credit unions that I have not, I've forgotten about over the years. That was just to secure my membership so that I could, get this financing on this car loan. So.
And that's exactly what's happened to me. If you think about what your local landscape in your town looked like 25 years ago, there was small town community bank. Many of them are gone.
Yeah.
So credit unions have really been able to fill that niche of not only being their small business lender, but the commercial real estate lender. I've seen credit unions do the truck loans for your small businesses, lines of credit card, up to the large scale commercial real estate for warehouses that we're doing today.
Mark, is it just tradition that people don't look to their credit union for this type of financing or this business financing? Or is it, I guess, what's the stigma there?
Tradition and perception.
Gotcha. Okay.
So much of it is people set up their relationships in their business, and it's that they're afraid to move it. Sometimes they're afraid to shop until they get ticked off with their local institution. And so much of it is, I didn't know you did that, or I didn't know the industry did that.
Right.
Last year, in 2021, the credit union industry did $40 billion in commercial financing. And that is going out there. Now, the other piece that knocks against us is many times credit unions are perceived as a small institution. They love their credit union, but they think of it as colloquial, hometown, cute little place on the corner.
Yes.
And they don't realize that if you need a multi-million-dollar type of lending relationship, they can do that too. Because and which is really the whole reason for my existence. Is we bring credit unions together. So if you need a $5 million loan, maybe your credit union on the corner can't fund the whole amount. But what we do is we bring the credit unions together to fund those loans, and you never know the difference.
Right. Well, it is interesting. And the more you say it, I think about, why do we love our credit union? Because I do. There's always a soft spot in my heart for a credit union. And I've been members, and I think I'm still members of a lot of them, because I am, I do my business banking and everything, and my personal with a large traditional bank. And, I see these scandals occur, and these fees come rolling through, and it just always leaves a bad taste. Oh, I'm going to leave these guys. Oh, I'm going to leave these guys. But you never say that about your credit union. Everybody likes the credit union.
When I first got into this industry with credit unions,
yeah,
I would be in a suit and tie Monday through Thursday, and Friday was dress down day.
Yeah.
And the credit union member wants that casual relationship.
Right.
And then finally, I figured out I make a lot more sales on Fridays because people like that more casual conversation and approach.
Interesting. Yeah.
The other thing was when you're at a bank, you're knocking on doors, talking to people all the time. And most of the time people say, yeah, that's nice. I got a bank. All of a sudden, I thought I was a lot better salesperson when I actually was, because when I said I'm with a credit union and we're here for their business, 9 out of 10 times people said, come on in.
That's crazy. That's interesting. Yeah.
We're an approachable organization. Credit unions tend to be much more approachable than your big bank, and they're conversational. But it's that perception, as you mentioned, that really puts up those walls where people aren't too sure if this is for them.
It's interesting, Mark, kind of my niche. My listeners tend to be privately held small businesses, and they prefer that casual approach, that's really, so I think what you're talking about is a great fit. And maybe, again, just that barrier, just not knowing what those folks can do. If we are looking at comparing both sides, what are the advantages? Why should somebody consider that over the traditional lending arms that they've looked at?
Sure. Well, first of all, let me talk about where we're similar.
Okay, sure.
We lend money.
Yeah.
My dollar lends the same as everybody else. My 3% or 4% interest rate is the same 3 or 4% interest rate as everybody else.
Yeah.
We're also regulated financial institutions.
Mm-hmm.
So sometimes people say, what's the process like? Well, when it really comes to collecting, I need tax returns, I need a financial statement, and I want to get that information. Okay, that part is the same. We have to show that you can pay back this loan. We're a nice organization, but we're not a charity, and it's not a given. We're expecting to get repaid.
Yeah.
Where it's different, you will see a much more conversational focused program of we want that relationship. We want to know that it fits you. We're looking at it from a community standpoint. That money that we're giving you comes from local deposits that we're putting back into the community. So if you're somebody that likes to buy local, you like your local small business, this is a great way to keep that cycle of money going locally.
Mm-hmm.
You're going to get that conversation where we can structure a product for you. We're not simply putting it into the machine, press a button, and it comes out yes or no at these terms.
Mm-hmm. Mm-hmm.
So because we're that community base, you can have that conversation. You also get access to decision makers.
Right.
If you're a commercial client and you want to talk to the executives about your loan process and loan decision, it's not a hard conversation. Most of the time when you punch their name in the directory, they're going to pick up and answer the phone.
Mm-hmm.
Everybody always wants that. We always talk about they want access in a relationship with a financial institution.
Sure.
This is that access in relationship. The other piece, especially with federal credit unions, nothing we do has a prepayment penalty ever.
Gotcha.
So the last few years when rates dropped with our loans and our portfolio because it was in the best interest of the people.
Mm-hmm.
You're working with an institution that's looking at you from a win-win type relationship,
mm-hmm.
because what a credit union is, a cooperative. There's no stock entity there. There's no board of directors that's cashing in and going to grow the business and sell it to the other credit union down the street.
Gotcha.
So when you look at that cooperative structure, it really becomes advantageous for you because you can build that long-term relationship with somebody who's going to be fair on rates and fees and terms, because we're not looking to make that quarterly earnings per share number.
If I could take a little, segue here, one of the things that the distribution community, and that's, what I serve, a lot of them, obviously have business lines of credit. It's pretty rare, although I have run into several of them that do not have a line of credit. And I think it's a stubborn notion there. But I've always believed that a business should have a line of credit and, use it judiciously. What are your thoughts on that? I mean, what should they be using it for?
I love lines of credit. And if you're a business, you're buying, you're selling, you're a retailer, you're a manufacturer, distributor, anybody, a line of credit can be critical. And the whole piece to a line of credit is to be able to manage it properly. Lines of credit should not be used for long-term financing. And that's where we see that mistake come in.
Gotcha.
The best use of a line of credit is you're going to take that advance off of a line of credit because there's X dollars of revenue to pay it off coming down the road. We're going to replace that, and the interest you spend is going to be better off because you're going to make more profit, and you can grow your business without worrying about the cash flow. Where we see people get jammed up into a line of credit isn't using it too much, but using it too little or not having a big enough line of credit. Yeah. Because as you grow, your working capital needs grow. And you really want an institution that's going to grow that line of credit with you. The biggest misuse that we'll see is when people start pulling it off and there's not their growth of their business or the cash flow, and there isn't that repayment. And then the next thing you know, you're stuck with a big line of credit balance that really you have to term out and amortize.
Right.
The piece that I would really caution people against, what we see as a death spiral these days, is when you turn on the news and every ad, it's the quick, cheap, fast business loans.
Yeah.
You can get your money today. You can get your money tomorrow.
Yes.
And that's going to give you that instant pop. A lot of these places, you're one step away from organized crime loans.
Right.
And they just want to keep churning your debt over and over, and it turns into a death spiral.
Yeah. I guess one of the things that's always bothered me, or the statement I hear from some clients is, I want to pay off my line of credit so I don't have anything. And I'm like, wait. That bothers me, because again, they're looking at it like a home loan, like a term loan. And I think that just drives me crazy. And so I've had to have this discussion with people many times about, for example, in distribution, one of the greatest uses of line of credit is cash discounts, to take advantage of all cash discounts. Yep. And really having to coach people on, okay, you pull the money to take the cash discount, and then you set a calendar date 30 days down when you are going to push the money back. And if you stay in that discipline, you can make money on this transaction. But sometimes that falls on deaf ears.
When it comes to your personal life, I lend money for a living, but I'm as debt adverse person as it gets into my personal life.
I hear you, man. I hear you.
When it comes to your business, you should be borrowing to make more money than you could just without the cash flow. Because as your business grows, eventually you grow too big. You can't be your own bank forever, or your customers can't be their own bank. There's a lot of tools out there. Now, when people are shopping for a financial institution, sometimes they treat financial institutions like they're a commodity. They really, to me, should look at financial institutions and lending options like they choose a restaurant. You can go to the local convenience store and get a soda for $2 that is fast, quick, cheap, and it's the most expensive soda you've ever purchased.
Right.
Or you can go to Costco and get the big case where, a bottle of water is $0.25.
Right.
And you're buying it in bulk. Not every lender serves the same meal. Some people like your business, some people don't. And really finding that lender that's a good fit for your culture where you're on the same page, and not simply going through the drive-through and getting the quickest, cheapest, most expensive meal you could.
Yeah, absolutely. I mean, you can definitely get yourself in trouble by trying to, as you said, commoditize that whole transaction there. And again, looking at that, use of line of credit, I think that there are missed opportunities often in these organizations where I know that accounts receivable, their credit management tends to be a big deal, and they hate people going out 60 days or 90 days. And I try to explain to them, it's like, well, there's another good use for your line of credit if you really want to capture this company that has this potential, and hopefully you're getting a decent profit margin, of course. But that's another great way to utilize this line.
What I always find is that the best and most desirable customers for your business, particularly in the distribution, tend to be the worst payers.
And that's funny because a lot of people won't think that way. Yeah, a lot of people have an adverse relationship to credit and credit management.
And it's okay to collect, but there's always that balance of, go to a mega corporation, go to the federal, go to the government and get contracts. They're wonderful contracts. There's sometimes plenty of margin. And if you're not set up properly, they'll drive your business into the ground because you'll find that you're getting paid in 90 to 100, 120 days.
Yeah.
That's another good example of using that to grow your business because you're going to get paid, but you don't want to grow your business out of existence.
Right. So I ran across this recently where the line of credit was collateralized by the real estate, by the owner of that business or the entity owning the location or the real estate, of any of the locations. I mean, I think that's a dangerous practice. I don't like that practice, frankly, because people they look at their operating expenses and they don't charge themselves rent, which they're fooling themselves at that point, But I think that, in my opinion, those loans should be collateralized by inventory. Am I wrong there?
No, you should really finance your business with your business and finance real estate as real estate.
Yeah.
What we do, probably 95% of our transactions where there's an owner operator, there's a real estate holding company.
Yes.
And then there's the business, and the business is paying rent. Now, I'm not a CPA, but there's a lot of tax advantages to that structure as well.
Right, right.
And it gives you the flexibility for the future as you grow, but it also gives you the flexibility in the future if you decide this business isn't for you and you just want to become a landlord and get somebody else into that real estate.
Yeah, yeah. Nothing wrong with that.
So it's good practice. It's good business. It's nice to separate the assets because if you can have that real estate as a separate remote asset in a tough time or a lawsuit, that real estate is a separate entity, then your assets in the business as well. So we're big fans of keeping everything separate from a tax standpoint, from a liability standpoint, and really to give you, the business owner, the most flexible ability in the future.
Yeah, I mean, and that's the way I grew up. I was trained that way. That was, the way, and I see a lot of that. I really do. But every once in a while, I will run into this situation where the two are combined. And that just always kind of scares me. Not totally sure why it scares me, but thank you for articulating why it should scare me. So when I do run into those situations, what kind of advice would you give someone if they are wanting to separate those entities? What's kind of that first step, and then maybe some long-term thoughts?
Yeah, the nice thing is you obviously don't need a realtor to do that.
Very true.
So you're going to save some money there. It's more of your attorney parceling the two out. Now, in most states that we deal with, you're going to have to pay a transfer tax.
Okay.
And that's where you can kind of gulp on some of the costs. But there's some things you can do to minimize that between the two entities. So depending on the particulars of your county, state, tax structures on transfers, that's your biggest consideration. But other than that, you're not going to have to get into the appraisals, inspections, the realtor fees and commissions like everything else. It's really your attorney. But what you're going to find is that the benefits very, very quickly outweigh the downsides of keeping your real estate and the business operations as two separate entities.
Gotcha. Would you recommend that principal or that owner operator use the same lending institution for both that real estate side and, in this case, your commercial line with your credit union or whoever?
The best place to get your next loan is where you had your last loan, because usually it's easiest and they like the relationship.
Sure.
You can, but you're not going to find too many advantages because what you're going to find is that you're going to have to run each entity through its own bank accounts. It might be easier if they're able to merge the accounts through online. And there might be some logistical easy there. But for the most part, if you want to shop it out and do a real estate loan separately, you could use it as separate institutions. But in today's world, everybody's looking for good loans. So your existing relationship might just like to do that. So
right. And I think, again, if they have a history with you and they know you a little bit and know the circumstances and they've seen the cash flow of the business entity, that they can maybe make that transaction a little smoother. So no, I think it's definitely great advice, to have somebody pull that out there. And again, over the years, I've seen a couple where that real estate was so heavily collateralized against the line that they were going to lose everything. They're going to lose the whole enchilada at one shot.
It also will put you in a little bit more disciplined approach, because a lot of lenders will keep lending and cranking the assets against that real estate as much as they can.
Right.
But when you have to run them as two separate independent organizations and operations, it could give you a little more discipline in the real estate and the business.
Yeah. And going back to an earlier comment, I think the thing that just does frustrate me is when an entity does not charge themselves appropriate rent, or at least does not put that onto the operating expenses in some way, that they're fooling themselves, how profitable they are. And I think it becomes very convoluted when that occurs.
Most of the time, you're going to charge yourself a rent to cover a piece. And that's actually a very good way to get some distributions out of the business,
yes,
in a tax advantage way, rather than just continuing to draw a larger salary. So I think you'd be very happy. If you're not a real estate holding company in your business, check it out, because I really think you would find that as a nice way to do things.
Well, and I think it's something you and I talked about. There's an advantage to separating that out from an estate planning standpoint, that maybe your heirs have no interest in this business and they can participate in the real estate. And, I think there's nice ways that there can be some separation, especially, maybe even you have siblings and one has a tendency towards that business, the other does not.
If you ever want a chance to sell your business, most companies that you would sell to aren't interested in your real estate. They're interested in the business.
Totally.
From a large scale business standpoint, just an all around planning standpoint, you're really setting yourself up for the long term flexibility to do what you want to do down the road.
Yeah. Mark, that's a great point, because I have run into that several times. I've seen that several times. People have given that advice over the years. And again, those folks who have got the two together, they don't tend to think about that someday they might want to sell the entity, and I've always challenged people. I'm like, look, your business should always be set up for sale, whether you choose to do it or not, it should always be positioned to be sold. And that's really running that business the best way humanly possible.
Absolutely. I couldn't agree more.
Yeah. So, Mark, how would someone get a hold of you all if they wanted to, explore the credit union side a little bit more and really understand what you all do and how commercial lending works inside of a credit union?
Sure. We have a lot of different variables, some different entities. We do small business loans. We do SBA loans. We do large scale commercial real estate. Mm-hmm. The easiest thing is to go to my personal page, Mark Ritter, MarkRitter.com. You can connect with us, see all the different things that we're involved with through the credit union space. And we'll either connect you with one of our credit unions. And if we don't have a credit union in your direct marketplace, we have lots of friends where we introduce you to credit unions that are lending to businesses and real estate investors in your area.
Gotcha. I appreciate that, Mark. And definitely we're going to put that in the show notes so people can get a hold of you. But yeah, I think it's just some of the things that you resonated with me were definitely the people like to do business with that community feel. And it really aligns well with the people that listen to this show, that I have on this show. And really, I think that is that relationship building type where sometimes the larger institutions tend to be that number. And I tend to feel that arm's length relationship.
Nobody's out there protested in the streets against their local credit union. So it feels nice to be on this. Sure. It feels nice to be on the good side of it. Yeah. So
very good. Hey, Mark. Well, hey, I truly appreciate your time today. And thanks for introducing this. This is a great topic for the listeners. So appreciate your time.
I really appreciated the conversation. Thank you very much.
You bet. Thank you for listening. If you liked what you heard, consider hitting that subscribe button. Links to sponsors, products, and services mentioned during this episode can be found in the show description area on your podcast application or at www.distributiontalk.com. Distribution Talk is edited and mixed by Andrea Klunder and Edwin Ruiz at the Creative Imposter Studios. This episode was brought to you by my company, The Distribution Team. We are a consulting services firm dedicated to helping wholesale distribution clients remove barriers to profitability, generate wealth, and achieve personal goals. To learn more about how we can help your company succeed, check us out at www.thedistributionteam.com.